Welcome back to the channel, guys. These past two videos we've been focusing on some of the more prominent asset classes when it comes to investing. And today we get into some of the real fun stuff and how you can implement that into your portfolio itself. As a reminder, this video is not financial advice, nor should it be construed as such. This video is strictly for educational purposes. As an investor, not only is it invaluable to know what type of investments there are out there, but it becomes equally, if not more important, to know how those assets interact with each other in your portfolio. This concept is called asset allocation. Asset allocation is the manner in which you split your money across different investment classes and asset types to balance the risk and reward that you're looking to achieve to meet your goals, your time horizon, and more importantly, your risk tolerance. I've mentioned this before, but in order to realize some of these higher returns or higher potential for returns, you're going to have to take on more risk. A proper asset allocation is going to take into account your investing goals while keeping in mind your personal risk tolerance, which is going to look different to everyone. To help visualize this, I want you to think of your asset allocation as a pie chart. And within the pie chart, you're going to see your asset allocation split between stocks and bonds, and you might throw in some cash in there. For the sake of keeping it high level and that this is intended for beginners in their investing journey, we want to keep it strictly to stocks and bonds. I'm going to keep crypto out of this, and I'm going to keep real estate out of this and those type of investments for now until we build a little bit more familiarity with those. Let's say you're someone with an aggressive approach to wealth building with a high risk tolerance. You might see a portfolio that is comprised solely of stocks. So it would look like 100% stocks, 0% bonds. Now let's take, for instance, you're someone who still has a aggressive growth approach to wealth building, but they might not have as high of a risk tolerance. That individual might consider involving some bonds into the portfolio. So they may have something along the lines of a 90 stock, 10 bond portfolio, or an 85 stock, 15% bond portfolio. So their pie chart is going to look a little bit different than someone with that aggressive approach with a high risk tolerance. Everyone's pie chart is going to look a little bit different, and it's going to be dependent upon what your goals are versus that risk tolerance you may have. You and I might have the same exact goal, but I might not have the stomach for the risk like you might, or vice versa. At the end of the day, your portfolio should be something that brings you peace of mind. You don't want to constantly be stressing about your portfolio, and a proper asset allocation can help combat those short-term fluctuations that you might see. With that being said, having proper expectations for what you're looking to gain is also going to help level set with what you can expect. For example, if you have a portfolio that might not be completely exposed to high appreciating assets, you should have an expectation that your returns may not be as high as someone who does. To better illustrate this risk-return trade-off, let's take a look at some research done by Vanguard over the performance of two different allocations for almost a period of a century. For this first one, we're going to look at a portfolio that's comprised of 60% stocks and 40% bonds. From 1926 to 2016, it's about 90 or 91 years. Now, this 60-40 allocation has returned 8.7% over that period. Now, this portfolio had its worst performing year back in 1931 with a negative 26.6% return. But it had its best performance 2 years later in 1933 with a 36.7% return. If you look at it over the years, it's experienced about 21 years of a loss over that 91-year period, averaging out to be that 8.7% we see. Now, let's compare that to a portfolio solely comprised of stocks. So it's going to be 100% stocks, 0% bonds. During that same period, the return has been on average annually 10.2%. compared to that 8.7% with the 60-40. And conveniently, the best and worst performing years are going to be the exact same, but let's take a look at those percentages. During that worst year of 1931, you would see a negative return of 43.1%. But 2 years later, in 1933, you would actually see a high of 54.1%. That's a wide range, hence that risk-return trade-off. Now, during that same 91-year period, you'll notice that the 100% stock, 0% bond portfolio has 25 years of loss. This is something very important to keep in mind, because while they both have the same exact best and worst year, you can see that the average annual return, because of the risk that one portfolio was taking on versus the other, are going to look a little bit different. There is no right or wrong answer to which one of these you should pick. It is really just dependent on your goals. Someone who has a lot of time to invest can afford to take on that little bit more risk and perhaps go with something like a 100-0 stock to bond allocation. Whereas if it's someone who doesn't quite have that much time left and they're planning on retiring, they're planning on meeting their objective time frame, they probably don't want to be taking on that amount of risk, because just imagine that time frame being on the exact same year as like a 1931. That would be tragic. A quick rule of thumb for determining what your baseline allocation should be, and obviously you can cater this to your risk tolerance and your goals, is subtracting your age from 100%. And that should be the percentage of stocks you have in your portfolio. The remainder should be something like bonds or fixed income or cash. As time passes, you'll see a lot of investors gradually start reallocating to bond or fixed income assets because they don't want to be carrying on so much risk heading into the latter years of their life. Because by that point, you'll have less time to make up any losses that might occur in the market. So you want to be prepared for that. One thing that I want you to keep in mind is just because you may be considered a younger investor, or you might consider yourself to have more time, does not necessarily mean you're going to have the same stomach for risk as someone else in your same age group. And the same can be said vice versa. There are certain investors out there who might be considered later on in their life, and they might have even more risk tolerance than someone who's 23 or 24 years old. It is just dependent on the individual and what you're looking to gain out of your investments. So we spent some time talking about asset allocation and what it is in practice. But how can you gauge what your own risk tolerance is, or what can you do to gauge what your asset allocation should be? Something that I like to do, and I encourage others to ask themselves, is how much loss in your portfolio would you have to see before you actually pull the trigger on selling out of your positions to realize that loss? If you are someone who can ride through the short-term fluctuations because you are of the belief that over the long term the market is going to outperform, then you might consider yourself someone with a higher risk tolerance. Whereas on the other end, if you're someone who would see a 2% or 3% fluctuation in your portfolio and you get nervous and decide to sell, you probably don't have that stomach or risk tolerance like a seasoned investor would. When determining what your asset allocation should be, here are some of my tips. Start out by writing down your goals. It's very important to know what you're aiming towards. And a lot of times people will not write them down and they just invest for investing's sake. Next, ask yourself some of those questions about risk tolerance. Put yourself in the shoes of someone who was experiencing that loss back in 1931 and try and have an honest conversation about what you would do. And then last but not least, probably the most important tip I can give is to be honest with yourself. At the end of the day, most investors tend to overstate their risk tolerance. That means they think they're more tolerant to risk than what they actually are when it comes down to it. Knowing this ahead of time can help you set proper expectations from the beginning and not be halfway towards your goal and decide to make a decision based on fear or irrationality. Remember, a proper asset allocation can be one of the most important factors when it comes to reaching your financial goals or falling a little bit short. So it's better that you have these conversations with yourself now than later on when it's too late. With that being said, guys, make sure you subscribe to the channel, share this with someone who can really benefit from learning a little bit more about asset allocation, and thanks for tuning in. Let's keep getting lit.